I'm your host, Sheldon Bro, a fisherman's son turned banker, turned mortgage pro, turned fintech founder. Finance Village is a podcast that caters to both financial professionals and consumers, featuring conversations that challenge and engage experts right across the industry. And our show's ultimate goal is to enhance the financial literacy of consumers while providing financial professionals with the best resources to serve their clients effectively. It takes a village of experts to ensure the best care for our clients, and Finance Village is here to help build that village. This is brought to you by Castflex Media, a podcast production company. And if you want to start or have a podcast that you want to make better, Castflex has the flex you need to make it easy and awesome. Today, I have a wonderful guest, Jarrett Holmes. He is a financial planner that specializes in helping realtors organize their finances, reduce their taxes, secure their future, and have some really meaningful engagement with their finances. When you're in a commission-only role, it can be even more important to have a financial planner, and he really helps them focus on managing every facet of their financial life, not just out there selling insurance or offering investments, but looking at cash flow and fueling every part of their component of their finances. So appreciate you coming on today, Jarrett, and excited to talk about both niches, which is what we're talking about today. Our topic is going to be navigating the niche and excelling in specialized financial advice. A lot of financial advisors, we hear this all the time. There's a lot of specialists that talk about it. You just recently made that transition, and I'm a huge advocate for Jarrett. He makes a ton of posts on LinkedIn that are super, super high value. I don't know where you have the time to do it. Still trying to find the time myself to get into the LinkedIn posts, but thank you for coming, Jarrett, and just give us a little intro about yourself and your background and how you got started in finance.
Sure. Well, thanks so much for having me, Sheldon. So I've been a financial planner for just over 2 years now. My background is in employee benefits and pension advisory, as well as advising physicians on their disability insurance and other personal insurance needs. But I've always had a bit of an entrepreneurial itch, and during COVID, I decided to take the leap into becoming a financial planner. Went out and studied for my certified financial planner designation, launched my own independent practice from scratch with another fee-based financial planning firm in Canada. Built a generalist practice, largely derived from my content on LinkedIn. All of my clients came inbound as a result of that. And within that general clientele, there were a number of realtors that had reached out to me, and they were seeking help with their finances. And so that was really the catalyst to me launching Unaffiliated Wealth and niching into the realtor space. I came to the conclusion that there were a number of common threads that were within those clients' situations that were creating a lot of financial challenges for them. And I had the knowledge and the solutions to be able to help them overcome those challenges, to be able to make a lot more forward progress than they were making. And so that's where I'm at today. I've been running Unaffiliated Wealth for about a year, and really focusing on working with those mid-career millennial realtors that are usually top producer, top achiever status, looking to incorporate, looking at securing their future, building solid foundation to build their wealth upon, and such.
So you're focused on, I guess, realtors that are doing well. They've made it, I guess, ideally past that first 2 years where you're trying to survive and build your business. And millennials, I'm at depending on who you ask. I'm born in 1981. I'm at the bottom end of being in that group. But I consider myself and someone like yourself and most millennials, someone that's they're still fresh, young thinkers, but they've got some tenure in that role, and they know what they're doing, and they've got some good experience. Tell me a little bit about the story behind Unaffiliated Wealth. You're not totally unaffiliated with anyone. You've got access to the biggest brands in finance as a planner for the things that you want to be able to offer to your clients as solutions. How did you come up with that name and concept of your brand?
Well, I'd actually had another name reserved for my business and registered actually with the Manitoba Companies Office prior to coming to the name Unaffiliated Wealth. I had a number of previous names actually, and then one night my wife and I were sitting on the couch watching a recorded Formula One race, and she just noticed that I was lost in thought and paused the race and asked me what I was thinking about. And all of a sudden, we were having an hour-long conversation about the financial industry and how it's nearly impossible to have a business or a firm that is, truly unaffiliated or as independent as you could possibly be. Most financial advisors are either linked to a bank, a mutual fund dealer, or a securities brokerage, or an insurance company. And I wanted to build my practice as far away from any of those as possible, realizing that we still need insurance companies because we need to manage and transfer risk. We still need investment solutions to be able to grow our wealth over time. But I didn't want the solutions available to my clients to be limited to or limited as a result of my affiliations with those firms. And so, knowing I wanted to launch an independent fee-based practice, and knowing that I wanted to be unaffiliated, I just hadn't come up with that name yet. I saw the perfect fit, and I think that outside of the finance industry in this day and age, we're seeing millennials and Gen Z gravitating towards more unaffiliated type brands, and so it used to be like everyone would want to wear clothes that had a logo on them. That's no longer as fashionable. People are now gravitating towards plain outfits or plain threads, as opposed to those that are displaying, say, a Nike logo or a Gucci logo or something like that. It might be just a plain shirt. Maybe it's manufactured by one of those brands, but people are less concerned with actually displaying that brand or being affiliated with that brand. And so I think that that's similar in the financial services space. I think consumers are less concerned about, oh, are you affiliated with this bank, or are you affiliated with this insurance company? They're more so concerned with, well, how are you operating your business? What is your fee schedule? How will you deliver advice? How will we engage with you? And ultimately, how are you going to help me reach my financial goals? They're not so concerned about, well, what are the products that you're going to be using? How are you going to help? How are you going to be helping me do that? And so
whose brand name is on the product?
Yeah, exactly. I mean, fees are important. The structure of the product is definitely important, but I don't think they're so concerned about, well, is it a Canada Life product, or is it an RBC product, or does my advisor work for one of the big banks? People used to view that as accelerating trust. They used to say, oh, you work at a bank, you must be the go-to person to deal with. And that's no longer the case. I think there's much more gravitation towards independence within the advisor community, and as a result of consumer preferences.
I'm really glad. So there's a few things you brought up there. I'm really glad that you brought up, and I've been on this tip for a long time, because I grew up with my grandmother. I had to iron my grandfather's clothes every day. I learned to sew at a young age and bake and all these things. And I was always more interested in the stitching and the fabric. And so when you talk about like people moving away from brand names, I think that's important, because if you have a big logo of a big institution or whatever, that doesn't mean you're going to get quality. And I can name a number of clothing brands that they have really, really bad quality, but you put that little logo on there and the price just goes way up because of the perceived market value. But people don't want a perception of value anymore. They want a quantifiable, a tangible quality. So that's a great point. And is it fair to say that, I guess, that your brand almost kind of accentuates that idea of fresh, new thinking, not just this old guard kind of, the way that things have always been done? You want to be able to offer some new methods, some new fresh thinking, let's stop focusing on the wrong things and start focusing on what's actually portrays the quality. Even I read a post by a gentleman on LinkedIn the other day that I'm probably going to repost today. A gentleman that had 1.3 billion that was at Merrill Lynch just went independent.
Yeah, I think that's, I'm not surprised by that at all. I think that we're seeing that happening a lot in the Canadian space with large advisory firms at banks going independent, whether it's through different channels that exist already or just going fully independent. Even some going as far as to drop their investment, whether it's mutual fund or securities license, and dealing by way of referral relationships with portfolio management firms. I'm seeing a lot of that taking place. But I think that my brand is really meant to accentuate exactly that. I launched my business during the pandemic. One of the things that held me back from launching a business for the longest time is wondering, well, where am I going to get clients from? I'm not surrounded by young, wealthy people by any means. That's not my natural network or my natural market. But I saw the opportunity to post on LinkedIn and provide people with value. And it just so turns out that that's how I've grown my business, is by attracting people, by providing value and having them reach out to me, scheduling into my calendar. And so I'm not growing my financial practice in the traditional way. I've never called a friend, a family member, a stranger yet in the 2 years that I've been in business and tried to convince someone that they should become my client for whatever reason. I find that when you provide value and you leave people to reach out to you when the time is right for them in their life, you're able to start the relationship off on a much more natural footing. You're not having to sell your services. It's more so, hey, this is how I work. This is what we'll cover if we work together. And this is the fee to work with me. Does it make sense? And it will either make sense or it will not make sense. And that's okay. But I find that the way that I've approached growing my practice is really so much different than, has typically been taught and done in this industry. And so I think that, just doing things a little bit differently, running a fully virtual financial practice, not showing up in a suit and tie necessarily to meetings. That would be totally awkward via Zoom anyways, but really letting my knowledge and my expertise do the selling rather than, an image or a fancy office like has been done for years in this space.
Well, one thing I can definitely share with you, and I won't go into much detail, but I've definitely seen, and we see it all the time, I guess, in different politicians and stuff. I've certainly seen in the financial industries, and very recently, people that are great at crafting a persona and crafting this perception, and then what's going on behind the scenes is not necessarily always the same thing. I would say that your posts aren't just valuable to the people that are interested in financial planning. I think you've convicted the hearts of a lot of people in the financial industry. I personally, I'm not a financial advisor myself. I've got a couple that I deal with, but I still like to regularly read them. Sometimes I actually will take a screenshot of your post and forward it to an advisor or even my own advisor. And I know a number of people in the industry that regularly are talking about how much they like your posts. So there's a lot of value there, I think, for everyone. And I love that you brought up, and I've tried to be the same way always, as far as, let me not go solicit friends and family. If they hear about my brand or they hear what I'm doing and they want to come to me, great. But let me go out and build it in a natural way in the market and provide value and provide insight and just offer tons and tons and tons of free advice without any pressure for anybody to do anything. Because this is what some of the, I guess, captive agencies often, and certainly the MLMs in the space, multi-level marketing financial advisory firms in the space will do, is here, go out and make a list of your 100 friends, your warm market, the people that we know that you'll be able to kind of, I personally have never been one to just, and some people will disagree with this. I won't, if my mother was selling cookies, I wouldn't buy the cookies just because it's my mom. They got to be good cookies, and then I'll buy the cookies and I'll tip. But if it's not quality, then I'm not super interested in it. So tell me, how did you identify your niche? I know you said that, you were getting a lot of messages from realtors and such. And were you just like, oh, realtors are really cool? Or did you figure like you're just getting a ton of more questions from them than somebody else? Or did you do research and say, I mean, we didn't have ChatGPT at that time, but were you Googling around and seeing, hey, who is an underserviced niche in this space? What was it personal interest or just activity?
A little bit of both. Yeah. So I guess I almost became a realtor in 2015, I was 3/4 done the licensing and education program, and yeah, I almost launched into that space, partnering up with my best friend who was a realtor at the time and still is a really successful realtor. And so I've always had an interest in it. I don't know what it was. I think the hustle aspect of the industry, and just being able to sell a high value asset and be involved in that crucial point in someone's life, buying or selling a property. Obviously, I saw the opportunity to earn a good living in the space, but then I guess I kind of got cold feet at the end of that process, and I also conveniently had an opportunity to join an employee benefits startup, which went on to do really well, and I ended up having a great 3.5-year career there. But in hindsight, I'm so glad that I didn't become a realtor, because I don't think that the lifestyle was for me. I value my weekends, I value my summers, and value time with family, especially now that we have a new daughter. And so a little bit of that is kind of baked into why I decided to niche into the space. Also, just having worked with a number of realtors in the very early stages of my more general practice prior to unaffiliated wealth, just identifying these sort of, I guess, planning challenges and opportunities that I found were leading to these particular realtors not making the progress that they were capable of with their finances. All of them had financial advisors at the time that they came to me, financial advisors and accountants in place. And despite that, they still weren't in the position where they were making good progress. They'd been earning hundreds of thousands of dollars for at least 5 years amongst all of them. And none of them really had anything to show for it. And they weren't living big lifestyles either, which I found quite surprising. They were living, relatively within their means. And so what was tripping them up was cash flow management. So with their cash flow, generally speaking, I find that a lot of realtors will just use one bank account in their business, especially if they're sole proprietor. Sometimes they're running their business and their personal finances out of the same bank account.
Oh no.
It can be very challenging to know what is available for paying yourself, for paying your business expenses, for income taxes that we all know come due, for remitting GST or HST. Usually there's no reserve fund in place. And so as soon as things get tight, the credit card starts getting used, the line of credit starts to build up. And so all of this sort of amounted to this black box of a bank account, not really knowing what dollars were serving what purpose, and not having the confidence to be able to send money into the future by way of saving and investing, not making as much progress in terms of paying off debts that have been accumulated, because they were left wondering, well, okay, I've got this money in my business. I just got paid X commission, but I don't know when my next commission check's coming in. So how much can I pay myself? Am I going to have enough money left over to pay business expenses? Oh, and it's April. I've got this tax bill that's due from last year. Shoot, I didn't set aside any money for taxes. Now I need to pay for last year's taxes with a line of credit or with next year's cash flow. And so all of that sort of just amounted to this rat's nest, for a lack of a better word, of a financial situation where there was a real lack of organization. There was a lack of, guidance from their financial advisors and their accountants. Most of their financial advisors just wanted to sell them mutual funds and sell them some life insurance. But I find that it's really hard to make the proper investment progress that they're capable of, and to be able to put the tax planning or reduction strategies in place to be able to buy the appropriate amount of insurance, or even to afford it, if the foundational aspects of their finances have been neglected. So not understanding how to manage and allocate their cash flow, not having a cash buffer in their business operating account, not having clearly defined separation between business finances and personal finances, not having a reserve fund to be able to float a shortfall in estimated taxes, or a slow period in the market, or a delay in a commission check, things like that. And so I really realized that by helping a realtor build a solid financial foundation, once that foundation is built, then we can go really fast with the investing. We can go fast with the tax planning. We can start looking at incorporating if the time is right and if it makes sense for their unique circumstances. But by jumping ahead to all of those things without building a proper financial foundation, it's all well and good until something falls apart and everything comes crumbling down. And so I really think about it in terms of this whole go slow to go fast type analogy, where we need to get comfortable going slow, doing the boring things first, putting the reserve fund in place, coming up with a system to manage and allocate the tax or the cash flow, saving proactively for taxes. And then, like I said, allowing them to go fast after the fact. Sometimes it takes a couple of years to properly lay that foundation. But once it's laid, then you can really start to plan out your future and secure it.
Yeah, and I think that that's something that's not as prevalent as I'd like it to be. And I'll speak about this part carefully because I think that there's in every industry in the world, including the McDonald's or the Tim Hortons that y'all stopped at this morning, somebody didn't wash their hands before they grabbed their Timbit. They just grabbed it with their bare hand. There's bad players in every space. I don't think that the financial industry is worse in that regard by any stretch. And there's a lot of regulation, thankfully, to oversee them as well. As in comparison to a lot of other industries. Realtors, I could definitely see how that's tougher, because with realtors and mortgage brokers, and I will say that, there's plenty of financial advisors out there that, are still doing work on outside of the 9 to 5 for sure. But it is a whole different ballgame because you're in a transaction that doesn't, it's time sensitive. So I can see that is a totally different kind of lifestyle. And it is really important to focus on cash flow, which, when you find an advisor that's willing to start your conversation on cash flow, and not just to discover how much money you have to buy insurance or investments, but to give you a coherent structure, to give you understanding, to give you, again, out from a mess of structure into something that it makes sense and that you can have ongoing intelligent, overview of, that is that kind of fear. When you don't know what's going on, it's terrifying to be able to save into the future, even for those small little things, like even doing $50 or $100 a month into a savings of TFSA or whatever. I was very lucky. I would say that the majority of self-employed people I've met started out where, you've got that entrepreneur hustle and you want to get into it and you don't make that early contact with a realtor. The only reason I've ever been able to stay out of trouble is because I have a little sister who's a bookkeeper who gives me a kick in the rear early. And when I told her I was leaving my banking salary, she, sat down and had a good chat with me. But there's plenty of people out there that you end up getting into this hairy mess before you realize, oh my gosh, I need to get a bookkeeper. I need to have a system. I need to know what's going on. And even when you mention and I think that's, again, a great part of the brand that you're building, and a lot of young new people are building in the industry, is when you're part of certain institutions or captive agencies, or, could even be, different MLMs and such. And again, I'm not grouping any particular ones in, but you kind of often will sometimes get too much training on one product or strategy. I'm a big believer that, I don't like overdraft, but it is a tool. I don't like, certain things, but there's tools. Everything's a tool. Everything has its time and its place. And there is no blanket advice. You can't give blanket advice in finance. There's
you
a
definitely
million
can.
different ways to do things, and everything is hyper specific. And it's really, nobody understands the variables better than the client. The client is always going to have like 1,000 additional variables that they've not told you about. Even if they've disclosed a lot, there's, the psychology of money and their family history and what their parents taught them. There's, a million different things and goals and fears that they won't always share. And again, I'm going to have a future episode coming up with a financial therapist, which is a very rare role, but I think a very interesting one. And I shared in my previous episode, there's lots of habits from my youth growing up with a single mother that, become ingrained in the culture of how you manage money. So, when focusing on realtors, or any niche, I suppose, I guess it would be important to an extent. or how important do you see it to kind of stay up to date on what's the changes to their industry? I mean, obviously you're not going to pay attention to every little change in their regulation and everything else, but there is certain kind of trends and developments you want to stay up to date on. And how do you do that in this industry? And I also would like you to maybe just quickly, before you get into that, comment on how you feel about the one product, one strategy. I mean, and I'm not gonna peg Manulife like this, because I do like Manulife very much. I think that the Manulife one is a fantastic product for the right person, and it's absolute disaster for the wrong person that's not really good at managing their money. So how do you feel about kind of the importance of not just having the one strategy focus, and then how do you look at making sure that you're up to date on the latest trends and developments for your niche?
Yeah, so I think the whole not having one strategy, one approach is very important. It's the classic, if all you have is a hammer, everything looks like a nail, and we see it time and time again with insurance advisors slinging whole life insurance towards, everyone with a pulse. It doesn't take away from the fact that a whole life insurance policy can be a great, financial planning, wealth accumulation, estate transfer tool. But if it's not used in the correct situation, then it can do far more damage than it can do good, right? And so I think it's the same with certain investment products, certain banking products, certain insurance products, certain tax planning strategies or vehicles. And I think that, again, further being unaffiliated gives you the ability to pick and choose from these tools and these strategies, and not be limited to those tools and strategies offered by specific, vendors or product providers, being able to cherry pick the best ones from all of them, based on the unique circumstances of your client. I think it's very important. And I think it's as important as ever to, for a financial planner and also for the consumer of financial planning services, to lead with planning and advice, to lead with real, genuine curiosity about, learning about someone's financial life and their current situation, how they view money, where they're looking to go, what path are they wanting to go down in a perfect world, and then bridging the gap between that understanding and their current financial situation, and helping them connect the dots along the way. I think that's what real financial planning is. It's less about the products. It's less about the tools. Sure, there's strategies and whatnot that need to be infused into the advice, but it really quite simply comes down to understanding, where are you, where you want to go, how can I help you get there? And then obviously these tools and strategies come into play. But sometimes there's an insurance policy or a tax planning strategy that may very well be suitable for someone, but not until, maybe 3 to 5 years in the future, after their foundation has been built, after, the correct work has been done to sort of lead up to that being the correct choice. The challenge with the industry by and large is that most financial advisors get paid to sell an investment solution or an insurance product. But if there's not a need for the investment solution or the insurance product today or in the next few months, there's really no reason why that advisor should be spending the time with the client to help them get from where they are to where they need to be. And so I think that's sort of the scenario that we see products being improperly positioned or pushed upon people, because inevitably there's going to be a race to get paid for spending the time with someone, admittedly or not. And so I really feel strongly about charging a fee for advice, in having an actual financial planning subscription or retainer fee, especially on the lower ends of investable net worth in the industry, because there are a multitude of Gen Z and millennials that have a lot of complexity in their financial life, whether it's due to high income, stock options, family life circumstances, business ownership, whatever, rental properties, those types of things, where they have a desire and a need for advice, but they don't necessarily have, 100,000, 250, 500,000 plus to be able to invest, which is generally speaking at the level at which you'd be able to access a higher quality level of financial advice. they don't necessarily need an insurance product. Maybe they need some term insurance, but the commission is only going to be $300 on it. That is not enough. $300 is not enough to spend the appropriate amount of time with someone to help them truly understand their situation and to be able to put things together such that they can really accelerate their progress from there forward. And so when you're able to charge someone a fee for spending your time with them on a retainer basis or an hourly basis, whatever it might be, you can really dedicate, the appropriate amount of time to discovery, to going through their information with a fine-tooth comb and really gaining a full understanding of their situation so that you can set the trajectory of the financial planning work that you'll be doing together, and then just chip away at it over time. And sure, there's going to be some products layered in there eventually, likely, insurance solutions, a need to invest because we all need to be able to grow our wealth. But I think that so often those things are put at the forefront, and the advice and the planning, gets put on the back burner.
Well, before you jump into the keeping up on those trends and developments in your niche, I want to comment on a couple of things you just mentioned there. So, and even though I really wanted to have him on the podcast, I'm going to give him a quick shout out and show him some love because we both love his content. You and I, Jarrett, have discussed it. Philip Setter. If you're a financial advisor, if you're a consumer, go check him out. I know that he's on LinkedIn for sure, YouTube, I believe TikTok as well. Really great videos, great content, and I think an honest, unbiased. He discloses any potential bias he may have. And one of the videos, because you talked about, everybody in the mother's offering whole life insurance, which is just anybody in any position. And he shared a video recently, which will have my producer in post-production insert right here after this little piece spiel that I have. But he's watching a video of and there's so many of them now about infinite banking. There's a million, and I'm not slandering infinite banking again as a tool. I know that there's a lot of strong opinions for it and strong opinions against it. And again, I just think it's one of those tools that you can use in the right situation. But he shows this video, and there's so many of these videos out there where it's like the government and the industry is hiding whole life insurance from you. It's the way that everybody should be doing and build wealth. And it's like, well, no, it's because the people, there's a specific group of people, a specific type of client that makes sense for. I don't think that there's any maniacal plan to conceal that information of anything. Like I said, it's talked about plenty by financial advisors, if anything, too often, when a lot of advisors are recommending, buy term and invest the rest.
It's whole life insurance. And this is probably the most underrated.
Who's this girl reacting? She's
underrated,
yeah, let him do my talking.
Investment of all time. And I think, no, I believe in all my heart underrated. It's kept this way.
It's not kept this way.
Because they don't want it to become some public thing.
Who doesn't want them to become a public thing? Who is keeping life insurance a secret? Look downtown. The biggest skyscrapers in whatever city you're in are insurance companies. You think they're keeping this a secret? No. They're selling this to every single person alive.
And I also want to touch on the fact that, and this has been something I've really been contemplating for a while, because I come from a very mid-market family, and paying for financial advice, because you either have to be sold something and they're making a commission, which I'm totally okay with somebody making a commission. There's lots of people in my life making a commission, as long as I trust that person's competence and their heart. As long as I trust their competence and their heart, I'm good with them getting paid commission. However, if it doesn't make sense for me to buy that product right now, but I still want financial advice, which everybody should want from someone, and most of us are just getting from our parents or our friends who aren't necessarily, highly credentialed in financial advice, we need to be willing to pay for it. And, you hear things like, because typically I think that range is, $100, $200 an hour for a lot of financial advisors. And people hear that, and sometimes they'll run for the hills. We won't run for the hills when we've got to pay, $1,200, $1,400 for the newest iPhone. But I think that there's more interesting things, ways of compensation coming out. I love the idea of the subscription and the retainer. I think that makes it very accessible, and it makes it more accessible for the mid-market. I've seen some big fancy firms and some small independent individual advisors doing it. I really love to see it. But I'm just going to take this moment to advocate for all consumers out there. When you get to the point of adulting, That includes a lot of things, not leaving dishes in the sink for, a week at a time and getting mold on them, which I've seen many times growing up. And, if you want a good, successful future, you want to be in a position when you meet that right person and be able to take care of your family members, whether it's kids that you have or whether it's people that you care about, your mother as she goes into retirement or whatever else it is. Be willing to pay, and be willing to pay, a good little chunk. And it's not to say that it's always going to cost a huge chunk, but stop being afraid of paying for financial advice. If you're just going to the big institution to get that out of the box kind of salesmanship, you may not always end up, and it could end up being a force multiplier on the long-term outcome, because starting early is a significant impact. So we're all out here spending, I paid $100 per dress shirt the other day. And now I'm trying to find very specific dress shirts because I got a little bit of a belly, so I need a specific fit. But, it's we've got fancy shoe where people are spending hundreds of dollars on shoes, more than $1,000 often on a cell phone, even though it's on a payment plan, which is technically similar to a subscription. So please, consumers, go out. It's for your own good. The financial advisors have gone through a lot of training, especially when you go into QAFP, CFP, CLU. There's a lot of study and effort and understanding and intelligence that goes into getting the kind of credentials that Jarrett and other financial advisors have. So I did want to share that really quick. Again, go check out Philip Setter. He's got a lot of great videos as well. And share with us now that second piece I asked you about. How do you stay up, or to what level do you feel that you need to stay up on the trends and developments in your niche?
Finance Village is sponsored by Pocket Finance, a technology platform on mobile app and web that improves collaboration and engagement between financial professionals, their clients, and their professional ecosystem. You can check it out at pocketfinance.com, and there is early adopter benefits on the go. And we are also brought to you by FinSense, a digital mortgage company serving all of Canada and ensuring that you get the same trustworthy mortgage advice that you would want your dear mother to get.
Yeah. So in my niche, a lot of it is, sure, there's regulations, there's legislation, like for realtors, the PREC legislation, the Personal Real Estate Corporation just came out, quite recently at different times in different provinces. And so, that's the big one that is at the forefront for a lot of realtors, a lot of brokerage firms. It's certainly, a consideration in how they structure their finances and carry out their financial planning. And so that's been a big one for sure. How do I stay up to date on that? Just reading the legislation that's released, the various accounting and tax and legal firms that are at the forefront in the realtor space, like Grant Thornton, for example. They're often putting out publications on the considerations from a tax and a legal standpoint. And so I'm always making sure that I'm up to speed on that front. Another consideration is, well, how do realtors get paid? They tend to get paid a little bit differently from brokerage firm to brokerage firm, based on whether they are running their own, business, or whether they're a team member within a team setting within the brokerage. Things like that obviously come into play when analyzing their income, understanding their GST and HST tax obligations, etc. Making sure that they've got a good bookkeeper and accountant in place is really important. That's something that I'll usually touch on quite early in my relationship with a new client or someone that we're deciding if they're going to become a client. Is, do you have good advisory in place all around? Because I can't necessarily play the role of the bookkeeper. I'm not qualified to play the role of accountant. That being said, if you've got no bookkeeper or a bad bookkeeper and a bad accountant in place, it can really hinder the advice and the planning progress that we would make together. And so I really prefer that we're all singing the same song, that we're all an aligned advisory team working in the best interest and towards the goals and objectives of the client. And so having those different team members in place, the accountant, the bookkeeper, the incorporation lawyer, if they are incorporated, just keeps lines of communication open, making sure that we're all doing our job and relaying to one another the various considerations that tie into the planning work and the objectives that we're working on.
Well, I think I love that point that you brought up as well as collaborating with other experts. I don't imagine it's easy for you to have all of the experts niched in realtors as well. They're probably, I'd say, majority of more than 50% of the time, they're, accountants or bookkeepers and lawyers and such may just be, they're still very, very useful, very intelligent in what they do. They understand, the different corporate structure and the clients they're dealing with. But having a group of people that is all niched for realtors would be tough to find. I will give a quick plug for Pocket Finance, which is coming with a full release very, very soon, both for financial professionals and consumers. Be able to collaborate with each other as consumers and professionals really easily, and you'll be able to more easily find the people that are in certain niches that are other professionals that you can work with. But one benefit, I guess, that they would have with working with you, and I think I would assume the accountants and bookkeepers and the different professionals you work with, hopefully really like that if they have a good chunk of their business or even a reasonable portion of their business with a certain niche, they really like working with somebody that is focused on realtors, and they're probably learning some pretty interesting things that are nuanced from you that they're not necessarily going to get from that generalist financial advisor. So how important is it to you to collaborate and offer more holistic conversation around your client with those other professionals? Because a lot of people, and I'm not going to say the majority by any means, but there's enough financial professionals out there that are just kind of dealing in their own little silo. And of course, if the client asks them or they see some super obvious need to talk to one of the other professionals. So how important do you see that level of collaboration? And then I guess, is it tough to assemble that team around your clients to get them to make the decisions? Are they going out and doing them? Are you recommending people that you know and trust? And then, how does that really work with you?
Yeah, it's really important for sure. I would say it's, I've noticed that it's increasingly important, especially for my clients that are incorporated, because, from the accounting and tax standpoint, there are so many more considerations, such as should they take salary or dividends or a combination of both? Should we be using a health spending account? Should the insurance be owned and paid for in the corporation or personally? Should we be utilizing the RRSP as a wealth accumulation and tax planning strategy? Should we be using the TFSA? Should we be retaining money in the company and investing it there? Do we need a holding company? All of those types of things that are, really at the forefront when someone does incorporate. And so I really want to make sure that I've got, collaborative advisory in place with both the accountant and the bookkeeper in those situations. Less important if they're a sole proprietor or if they're, not a realtor, and their finances are pretty straightforward. But there's obviously conflicting views between a lot of accountants and financial planners. Accountants tend to see things very much in the here and now and retroactively when they're looking at tax, whereas as financial planners usually look on a go-forward basis. It's the whole, looking at reducing the taxes as much as possible in the current year. Meanwhile, maybe it makes sense to pay taxes in the current year to be able to save tax over the lifetime. And so I think that bringing both of those viewpoints into focus and having the client understand, well, what are the trade-offs to consider in both of those situations, and have them make an informed decision, really helps. And so I think it's really important. I don't necessarily go out of my way, very early into a new client relationship to mix things up and try to build my own advisory team. With the accountant, bookkeeper, lawyer, etc. That being said, I will usually look to get an opinion from the client on how things have been going with their accountant. Are they satisfied? Are they tied to them? And if they're not, and if I notice that the accountant is, working on a very transactional basis and is not really willing and able to collaborate from an advisory standpoint, that's usually the point where I would look to make an introduction to one of the professionals that I've got experience working with, that I know are very much of the mind of, financial planning is a part of their job as the accountant, not just transactional tax preparation and those types of things.
I'm a big advocate for that as well. And I even as, I don't do the actual mortgage transactions anymore. I'm a managing partner. I help create really efficient operations, digitize our process, and do the business development. I was always, even as a mortgage advisor, asking people, do you have an accountant? Do you have a financial advisor? I think even on the mortgage agent, mortgage advisor, mortgage broker side of things, we need to focus on more holistic advice. It's a huge purchase. Collaboration is super important, and scrutinizing the people that, and it's not to get, I don't like where it's like, if somebody's getting advice, we need more collaboration. You don't want people to be like, oh, well, your lawyer's saying this and I'm saying this, and now we're like enemies type of thing. It should be collaborative. We should be having the conversation together, not have our back up against the wall because you're talking to someone else that's in the financial field. And there has been a ton of times, I would say, in my experience, I don't know that it's common or not, but in my particular experience, it's been probably about half the time, as far as the bookkeeper and accountant side, whether it's, and it's not to say that they're not competent, but maybe the bookkeeper has taken on way too many clients, or maybe the accountant is just not responsive. You're waiting 2 weeks for a response. And I guess it would be fair to say that if you're not working with a good group and you're just being like, oh yeah, whoever you have is good, I'll just trust that they're awesome and hopefully I'll be able to collaborate with them, that's going to impact your ability to do your role, wouldn't it?
Yeah, absolutely. And at the end of the day, even if it's just time in and of itself is important, right? And so if my client or myself are left waiting, 2-3 weeks for an answer, that it leaves things in abeyance where we're just waiting and waiting to handle something that could be, often done quite simply and quite quickly, if the answer is readily available. And so something that I'll usually do from the get-go with a new client is just get them to provide their written permission via email for myself and their accountant to correspond back and forth on their behalf, copying them in on the thread, so that I'm not having to deal through my clients. I can deal directly with the accountant. And so there's, ideally that understanding that we are going to be collaborating, from the very early stages of working together, especially when someone's going through the process of newly incorporating, for example. Usually there's a lot of uncertainty. There's, a lot of changes taking place in terms of their banking systems, in terms of their reporting systems from a bookkeeping standpoint, understanding that there's this wall between personal and corporate tax. And every time money crosses the line, there's a tax event that takes place. And so I really see there being quite an opportunity to educate our clients together, both myself and the accountant, on how various things work. And then setting compensation strategy, whether it's salary or dividends, talking about the tax scenario that will correspond with that decision, and doing as much proactive planning as possible, so that we can put the client in a good position on a go-forward basis, and so that we're not having to, potentially undo a mess retroactively because that advice wasn't given on the front end.
Yeah, and that's the key. And I guess I'll hopefully all professionals would understand this. Again, I know sometimes some professionals feel like they're back against the wall as soon as you're having a conversation with anybody else other than taking your one silo advice as a religion instantly. It's really all about the client. It's not about you wanting to change their accountant or anything else. If they got an accountant that's suitable, it's totally awesome to be able to deal with them, somebody they've already been working with. But backtracking from a bookkeeping or accounting mess can be very stressful, it can be time consuming, and it can be kind of pretty hard to get things back on track. And like I said, I've seen it many, many, many times. What are some of the more interesting, and I feel like I want to call Jason Pereira right now because he told me about one last week, and I was just sending a text to him like, I'm going to call you in 2 minutes. Don't ever be texting people on Zoom calls. I see it happen too often. Focus on the person you're talking to on a call. What are have you seen any really interesting niches? Because I can't remember what it was, but Jason was telling me in a conversation I was having the other day with somebody in the US. It was like unbelievably hyper specific to the point where I was like, you're not even going to find one. Like, it was just so specific. What are some of the more interesting niches that you've seen out there?
Yeah, so Jason might have mentioned the pro fishers in the US.
Yes. How did you know that?
He actually told me on a Zoom call about a year ago when him and I were talking about niching before I'd gone down this path. It wasn't overly clear what my niche would be and how I'd go about it, and so that was an example that he threw out to me, and that was the most hyper specific one that I could recall. But there's a few other examples. There's someone here in Canada that is niched into the midwife space, which is very, very focused. I'm not sure if his wife or a family member is a midwife, but I thought that was really
and he
cool.
mentioned that during the same thing. Remind me, what is a midwife?
A midwife is a medical professional. They're not a doctor. They're not a doula.
It's not a
but
doula, okay.
They assist with the delivery of babies. Yeah, and so often they will play the role of the obstetrician, to a pretty great extent in the birthing process. And so there's some considerations that surround that he's become an expert in. I know of an advisor in the US that is niched into the tattoo artist space. Obviously there's considerations there. There's, self-employment, there's variability in income, having to rent a chair, the atrophy of their body over time, and having them have to plan for retirement / financial independence or career change sooner in life, because they're not going to be able to tattoo at the same rate that they're able to when they're young and when they're healthy.
I never thought about that. You get older, and you're not going to be able to do that looking as nice anymore, eh? And I wonder if people are getting into the even deep, because every time I talk about niches, again, Jason and Grant Hicks and a lot of people that have a lot of intelligence around this, Michael Kitces, they're talking about the more specific, the better. I mean, even you're talking about, okay, I only deal with tattoo artists that tattoo hearts, for example. But you've embarrassed my memory, because that was a year ago you had that conversation with Jason. I think it was less than 2 weeks ago I had it with him. And he both mentioned the pro fishers, and there was, I think, even a tiny bit more specificity to it, and the midwives in that conversation. But so it just goes to show you how entrepreneur brain can hack away at your memory.
Yeah, and yesterday I just came across another niche, and his niche is online creators and online gamers. And so I think I have his website up on my phone. I can send it to you after, but his whole website is built around a Mario theme. And so it's very specific to people that, enjoy playing video games, and even further to that, online video games. And so the verbiage or the wording and messaging on his site are very specific, as well as the imagery that he's used. And I think it's become so much more effective to niche in this day and age with the internet, right? Because we're no longer limited to only dealing with people in our local geography. Like, I'm in Winnipeg, and I would say at this point, if I were to estimate, I would say 75 to 80% of my clients are not in Winnipeg. Some days I'll be having meetings with people, as far on the West Coast as possible on Vancouver Island. And then later that day, I'll have a meeting with my clients that are in Newfoundland. It's wild. And so I don't need to focus so locally when I can, almost go online and cherry pick, essentially, by way of my messaging, my targeting, and where I show up, on different platforms, the people that I want to, ideally attract into my ecosystem, so that I'm on their radar when the time is right for them in their life to engage financial advice. And so I think that I think that holds true with all niches, really. It's really about finding out, well, who is your niche? Where do they hang out online? I think most people hang out online to some degree these days, and finding a way to get your face and your messaging front and center, and to just communicate consistently, putting your key message in front of them in many different ways. So learning to say the same thing 50 or 100 different ways to switch up your messaging so it doesn't grow stale, but just staying top of mind for people, so that you're the go-to guy or girl when they're looking for financial advice.
So 3 things. One, I'm going to insert, I want you to send me that gamer site because I totally want to see it myself, but I'm also going to show a screenshot of the website right about here, post-producer. And I think that you probably have an easier time doing, so I'm a big advocate for doing business remotely. Long before COVID, I was trying to make sure to focus on doing remotely. If people really want to meet in person, I'm happy to do that, but you can definitely see that I'm a real person on a Zoom call, and you can sit. I don't mind if customers have because not everybody wants to be on video and whatever. So if customers want to sit, on their couch in their underwear and leave their video off, I'm happy to do that. We'll make sure we still have our video on. And we show them, that we're dressed and we're professional for the day, and we're able to show them our face that we're a real person. But I would think that it helps, niching helps you be remote in a way that you can do business in more provinces, because now it's not just, well, who can drive to me? It's, well, who fits this niche? Who fits this ideal client that I'm trying to help? And wherever they might be in the country, and again, they are often hanging out at the same places online. So it really speaks to the fact that you can easily do from BC to Newfoundland and help those same people. And usually there's not an incredible amount of provincial differentiation in the advice that you're given, right?
Yeah, no, there rarely is much provincial consideration except for in the province of Quebec. And so I don't have any clients in Quebec. I think there's some unique legislation around insurance licensing for sure there. I mean, I could in theory have clients in Quebec and just not write their insurance. I could refer it to someone locally. But yeah, I don't think there is really too many considerations. One is GST versus HST. So that's something that I need to be mindful of, but is usually going to be handled by the bookkeeper and the accountant. But in terms of helping them manage their cash flow, there's a little bit of consideration there. But yeah, to me, it doesn't really matter. The whole virtual world has really opened up so many possibilities in terms of how to run a business and how to give financial advice. Particularly as it relates to screen sharing. Here I am sitting with two 27-inch monitors. I can very, very clearly see my client on the one. I can have the focus of the meeting on the other, and we can navigate through different tabs. I can access everything that I might possibly need at my fingertips within seconds.
And you can record if you really need, I guess, because it's going to be kind of weird for somebody to come into your office and you got cameras set up and you're trying to record it that way. It is actually can be very much more convenient for the client if they want to refresher on the conversation they had with you.
Absolutely. Yeah. And another thing that I find to be really convenient too is sometimes people need to cancel, or sometimes they need to reschedule, or they just no-show you by mistake. When that happens in a physical setting, you're really inconvenienced when that happens. But when it happens here in this virtual setting, I just move on to the next thing that I have to do that day, or else I go for a walk or grab a coffee, and I find it's far less inconvenient when things like that happen. The other thing too is I'm often able to meet with clients, a husband and a wife or two partners that are in different places at the same time. So maybe one's in their car, driving, or parked in a parking lot, meeting on their phone, and the other one's settled at their desk in their office or at home. And so it's just so much more accessible than meeting in person. And if I can at all control it, I try to meet virtually 99% of the time, just because it's far preferential to me, and I think to my clients as well.
Totally agree, for the clients as well. I mean, gas, wear and tear in the car, scheduling, everything else. So as we wind up a little bit, I am going to ask you, do you think that advisors, and I'm going to continue to, I think, ask this question semi-regularly on the podcast to a few people. Do you think advisors can successfully operate in multiple niches, or do you think it's better to focus on one? And this probably isn't a definitive answer. It's probably more of an opinion-based thing. But what do you think as far as, is it? I mean, obviously anything's possible, but is that still something where it's clearly better to you to focus on one, or because it could be I could see someone, because realtors and mortgage brokers have a similar.
I was just going to say
kind of go,
Yeah, I think it's definitely possible. I don't know if it's preferable, just from a marketing and a messaging standpoint. Obviously, there's parallels between a lot of certain segments in the market, like you mentioned, realtors and mortgage brokers. The ones that come to mind for me is the variability and the irregularity in their cash flow, the fact that their income is centered around high value deals, the fact
and the housing market.
The housing market
hugely impacts us.
Definitely a common thread there. The seasonality, the housing market is driving everything there for sure. Interest rates, and then also self-employment, is a very common thread there. The ability to incorporate, from what I understand, mortgage brokers are able to incorporate as well. And so there's so many common threads that could be quite easily adapted back and forth. That being said, if your website and all of your messaging online communicated to two separate niches, or mortgage brokers and realtors, I think you'd have to be a lot more crafty in how you generate your content and the messaging that you communicate, because even though there's so many similarities, I might, as a consumer, gravitate to someone that just works with realtors rather than the person that works with realtors and mortgage brokers. Or if I was a doctor and you say that you work with doctors, dentists, and veterinarians, but there's another advisor that only works with doctors, I might gravitate towards them. And even further, if there's an advisor that only worked with vets, I think that I would probably want to work with, just the advisor that works with vets. And so I think it really depends on whether there's, close parallels between the two different niches that you might be considering going after. But I really don't think, like we just talked about, like Jason, would say, like Michael Kitces would say, is I don't think that you can go too narrow. It can be very intimidating niching. I definitely experienced that anxiety of transitioning from talking to everybody on LinkedIn to, almost talking to nobody except for the people that I'm saying that I work with. And truth be told, I saw my engagement on LinkedIn go down as a result of that. But I also saw the number of inbounds stay relatively the same, maybe even increase. And so that really just goes to show that there's definitely people seeing your message, and just because they're not liking and commenting on your message doesn't mean they're not seeing it and it's not resonating. But when you have a generalist practice, let's say you start out and then you decide to niche later on, it can be a little bit unnerving to think that you're saying to all of your existing clients, hey, I don't really work with you guys anymore. Obviously, I've continued to work with all of my clients. I haven't had a client leave me yet, fortunately. But they all know that I'm niched into the realtor space, and it doesn't mean that I'm no longer able to advise them appropriately and help them with what they're going through. It just means that the majority of my focus on a go-forward basis will be on marketing and communicating with the segment, as well as becoming an expert in the issues and concerns that they're facing in their financial life. And so there's definitely points of friction, and there can be some anxiety that results in the process. But I think that personally, niching is the way to go. It's working out well for me, and I'm so glad that I decided to go down this path.
Well said. Well said. Well, last two questions. What are some of the most common pitfalls that you see realtors fall into when they're not getting that financial advice? And I know we touched on them, but maybe just highlight two or three that you think are the most prevalent. And if somebody's experiencing that, maybe it would be wise for them to reach out to someone, and specifically you.
The one that I've been seeing most recently that frustrates me to no end is the premature incorporation. I think that there's almost a badge of honor or a status symbol that comes.
I was going to ask you why.
Yeah,
I think that is true.
Yeah, I think that there's this. It's almost like I hate to say it, but like a status flex by having the letters PREC or the word PREC behind their
branding,
name
not
on
quality.
their signs. Yeah, I think that there's this perception that it signifies, hey, I'm doing really well, and often it does signify that they're earning a high income. But what I think a lot of them fail to realize or haven't been properly advised on is that they're just signing up for higher ongoing tax and legal bills, and if they're not actually retaining any money in their company, as a result, they're doing it all for naught. And so
And
I'm
it's not
seeing,
small. It's a considerable increase.
yeah, I would say it's $1,500 to $2,000 per year in additional cost, but also the added complexity of having to have more stringent bookkeeping and banking records in place to remain compliant. They're signing up for a huge ongoing or a sizable ongoing bill and a life of unnecessary complexity to get no marginal benefit as a result. And so incorporating at the right time, I think, is so crucial. I think a lot of lawyers and accountants have made a killing off of the new PREC legislation coming into play, and there hasn't been a lot of advice given in terms of, well, when does it actually make sense for you to incorporate and put a PREC in place. So that's a big one that I run into, and creates a lot of headache. Another one is what I call the tax hamster wheel. It usually is associated with dividends being taken from a corp, but often sole proprietors run into it as well. It's when they don't set aside, because as you and I know, you need to pay your taxes as a self-employed person. You don't have them payroll deducted like you do when you're employed. They don't set aside, the right amount of money for taxes, if anything at all. And then, tax season rolls around the next year, they find out that they owe, 30, 40, 70 grand, whatever it might be. They've spent it all on their business or on their lifestyle. And so there goes 30, 40, 70 grand of next year's income to pay last year's taxes, in addition to the taxes that will result from next year's income. And so it snowballs, and it's a very hard pattern to get off of, or it's tough to step off of the hamster wheel and get current with taxes. And I think that it's very challenging to be able to make forward progress. It's hard to build up a reserve fund. It's hard to invest for the future when you are constantly in arrears with your taxes. And so that's a huge one.
And that's a big one, I guess, for most business owners, not necessarily just exclusive to realtors. I'd say
it's business.
I mean, even drywallers, anybody I've seen, business owners, it's just
100%. Yeah. So there's that one. There's also the, floating your lifestyle with a line of credit, which I see all the time. So during slow periods, if there's no reserve fund, if there's no cash buffer, or if there's a delay in a commission check, which is pretty common because commissions are paid at closing, then, if their funds run dry, they end up accumulating credit card debt, putting money on a line of credit. And I think that a lot of them have actually been taught to do that by their brokerages, or they'll draw on their commissions. And so they'll take an advance on future earnings. And so what that does is you're just paying for past purchases with future income, like any debt, right?
Where are they getting this advance from? I've not heard that before.
Yeah, so brokerages will advance commissions to agents of their brokerage firm. So if they have a commission,
they don't do that in the mortgage space.
yeah, and so if
I guess I've never asked, but I've never heard of it.
I see it quite often, with high producing and lower producing agents, and so it's pretty commonplace. And again, it signifies to me that they are not managing their cash flow properly, and or they're living above their means. Because at the end of the day, you earn X amount in a year, whether you earn it in a lumpy manner or in a consistent manner. And you need to find a way to make it work. And I don't think debt is the solution. I think that line of credit can be good for bridging income between tax years to be able to manage a tax bill. But if you're using it to float your lifestyle, then I think what really needs to be done, or the solution, is to start using pools of cash as a tool. And you and I, like everyone else, we hate cash earning nothing, or now actually earning something, but generally pretty unproductive compared to what it could be doing. But I think when you have such a high level of variability and irregularity in your income, cash can be a godsend in terms of being able to borrow from yourself rather than borrow from an institution and pay interest and using other people's money to live your lifestyle. And so what I like to put in place for my clients is sort of a cash flow allocation system where they would have the buffer established in their operating account equal to X number of personal income payments and business expenses, having that reserve fund established, usually at least 3 months worth of business expenses and personal income payments, so that when they run into that lull in their business, they can draw on it, but they've got this allocation percentage where they're constantly replenishing it in a systematic manner. And so it just becomes a component of their financial ecosystem, if you will. It's a tool that is allowing them to stay above water. It's allowing them to avoid spending money that they've set aside for taxes. It's allowing them to avoid accumulating high interest or unproductive debt. It's allowing them to avoid liquidating their investments. And so it's just propping up everything else. And so that's another one that I see quite often, not separating business and personal finances. I see all the time. Those are a few of the ones that come up quite often that I see as really hindering realtors' progress at a large scale.
And not just separating the business from personal, but I would even encourage people to consider or discuss with people like Jarrett. Well, then even within my business, do I want to have a couple different accounts in order to segregate?
Absolutely.
And not just, and to be fair, and there's no hit against infinite bankers, but when Jarrett says borrow from yourself, he's not talking about borrowing from yourself.
No.
Infinite banking policy way. He means have emergency funds, which is unbelievably uncommon. I think a third of people in North America that are making $250,000 or more are living paycheck to paycheck.
Right.
And a ton of people, can't tell you how many people I've dealt with that have been in the financial industry at big banks and in financial advice for a lot of years that don't have still those types of things in place. So that is one of the staples. It's one of those core things, one of those things that, thank God that, a lot of good advisors like Jarrett that actually go into cash flow in the proper way are actually talking about. So, so I guess the last thing I'll do is just a quick plug for you, Jarrett. I've known you for, my perception of time is really poor. My memory obviously is bad if I could remember my conversation with Jason 2 weeks ago, but it seemed a year. I remember you telling me about the transition you're making to affiliated wealth. So I guess we've known each other for over a year. I have talked to tons of financial advisors from originally my role at Bank of Montreal, where I was tasked with going out and finding lending for cash surrender value, leverage, unsecured mortgage and such with financial advisors. Then going out to start my own mortgage company and talking to financial advisors across the country because we always were, again, remote and digital and doing business in most provinces. And I've talked to a ton of financial advisors because of the financial technology that we're building for consumers and financial advisors and professionals. I can say with great confidence, and I've talked to hundreds and hundreds and hundreds of advisors, I've presented in front of hundreds. Jarrett is one that I really, really would strongly recommend. Again, the two things I'm always looking for in anybody I'm dealing with, and often this is personally and professionally, is the heart and the competence. And I have not had Jarrett, deal with my finances. You can clearly see the competence if you look at any of his historical LinkedIn posts, or I guess you're on Instagram now as well, and getting some good traction there. But I can tell you that the conversations that I've had with Jarrett, I fully trust his heart. The being in, he's not in this industry, as I usually say, to get a BMW and be the slick back, what's that movie called with the guy, Wolf on Wall Street type of guy. He really wants to make a difference. He wanted to be able to have his own independent brand. And I really, really strongly recommend that if you are a realtor in any province, if he's not licensed, he may get licensed there for you, or he may recommend you to someone that he trusts. But reach out to Jarrett. Jarrett, just give us one more quick little plug on the clear summary bullet point specificity of what your ideal realtor looks like and how people can reach you.
Sure. Well, thanks so much for the kind words, Sheldon. I really appreciate it. It's been a lot of fun having this conversation today. My ideal client is, really not so much about how much they have to invest. It's really about the stage of their career that they're at and what it is that they're wanting to accomplish in their life, financially speaking. And so what I'm looking for is someone that has proven that they can succeed in the business as a realtor. So they're able to obviously generate the income that's sufficient to live their lifestyle and to fund their business endeavors. And, usually they're at a point where they're starting to think about, well, hey, I've got some surplus cash flow in my business. I'm wondering what I should be doing with it. Or I'm paying a lot of taxes. I'm wondering what the strategies are that I can implement in my business and my personal life to be able to manage and to reduce those taxes effectively. I'm wondering, I've been working for X number of years really hard in my business. I'm really enjoying what I'm doing, but I'm wondering, am I ever going to be able to step away from my business and eventually retire or achieve this, state of financial independence where maybe you're working because you want to, but you don't necessarily have to. You don't need to continue to earn active income to fund your lifestyle. When am I going to reach that point? Am I on track? If I'm not on track, well, what do I need to change in my life to be able to get on track? So those are the conversations that I'm often having with my clients. How can I most effectively manage my cash flow to make sure that I'm allocating it to the correct areas, and so that I'm isolating my surplus so that I can allocate it towards my future with the confidence that I'll still have enough money left over in my business to be able to perform all of the functions that it needs to perform, pay myself, business expenses, taxes, etc. And really someone who's just looking to take their finances to that next level, looking to really get organized and make sure that there is optimization in place across really all area of their financial life. And so those are the people that I'm looking to work with, people that are motivated, people that do have a strong level of orientation towards their future, which I think is crucial. When planning for your future, you have to be able to sacrifice, a little bit of lifestyle in the present, because you can't have everything that you want. You have to be prepared to be able to, make trade-off decisions with regards to your financial future. So that's usually what I'm looking for.
And again, I'll advocate to consumers, we're spending there. We are all spending and living, again, our cell phones, our shoes, everything else. We got to be willing to make that call. And one last thing I want to point out is just because I always see that people are always delaying that first call because they're expecting that. Let's even say that it existed to an extent, that very high pressure first sales call. I've never gotten a molecule of that from Jarrett. If somebody's thinking about it, let's say that a realtor that fits that box is listening to you right now, but they're wondering, well, what do I expect from a first call with Jarrett? Is he gonna charge me $1,000 for that first call just to see what, if we're a good fit? Is he gonna, immediately try to push a product on me? What does that, how do we make sure that they understand that first call is friendly, and what does it look like with you as we close out?
Yeah, so our first interaction is a 30-minute chat, and the purpose of it is simply to get to know a little bit about one another. Usually it's me asking a number of questions about why you reached out in the first place, where you're at with your finances today, where you're looking to go, what you might be viewing as challenges that could be holding you back. And then it's a chance for them to get to know how I run my practice, what it is that we would cover in their financial life from a planning and advice standpoint. If we did decide to work together, them getting a feel for the way that I ask questions and the way that I communicate. And ultimately at the end of that meeting, deciding, well, does it make sense for us to have another meeting? And in that case, the next meeting is a complimentary discovery meeting guided by a couple of questionnaires that them and or them and their spouse would complete separately, ideally if they're in a relationship. And then the purpose of that meeting is to dig a little bit deeper into all areas of their financial life, not so focused on the numbers, but really on the why, the goals, where they're at, where they're heading, what some of the weaknesses and threats might be that we should be focusing on. And then at the end of that meeting is usually when we would decide, well, does it make sense for us to work together? And in that case, putting together a financial planning letter of engagement. And then at that point, we would charge the fee for the financial planning advice and start to lay out the groundwork of what is to come in the financial planning process.
And again, we should all be excited to pay that financial planning fee because the impact on your current and long-term finances is going to be significantly outweighed by that in the vast majority of occasions. If you're dealing in all occasions, if you're dealing with a good advisor, I would suggest. Unless the entire market crashes. So as we end, Unaffiliated Wealth, Jarrett Holmes, follow him on LinkedIn for sure, including if you're a financial professional, you'll definitely get value and you'll enjoy his content. He's on Instagram. Where else you at? We're going to plug your email at the bottom of this if you're all right with it.
Yeah, absolutely. Yeah, you can include my email. You can include my website, unaffiliatedwealth.ca. And yeah, otherwise just following me on LinkedIn and Instagram. That's where I'm at online.
Yeah. So again, one of the young but tenured, credentialed advisors out there. Highly recommend them. I really appreciate you coming on and taking the time out of your day. Your time is very valuable, and I appreciate you giving some of it to Finance Village podcast. And hope to talk someday again soon. And thanks again for coming.
Thanks so much, Sheldon. It's been a pleasure.